Here's a chart of the E-mini Dow for August 10th, 2007. 2-minute chart, and you notice that price action is moving into the zone near the peak volume price, where the market will have to make some decision as to which direction it wants to go. A trade might have been taken here at the VWAP, but if our trader was smart enough and used the Shapiro effect, he would not have entered this trade at this point. You can read about the Shapiro effect in the last thread. So here we see the market passing right through the peak volume price and up to the first standard deviation, and breaks through. You might have taken a trade here. If we were smart and we took the trade here, we would immediately put our stop at break even. Trades in this region are very difficult to do. Any kind of breakout can suddenly turn right around and go right back to the PVP. So we have to be very careful here. If you took a trade here at 13,213, you should immediately put a break-even stop as soon as this market moved up, which it has at 13,224, and just see what happens. And market's heading back down again, and so we're stopped out. But we didn't lose any money on that trade. So we wait for the next breakout, if one's going to occur. Again, the PVP is right here at 13,203. VWAP down here at 13,178. And we're in that danger zone region where anything can happen. There's usually a lot of volatility in the markets in this region. Prices will often oscillate back and forth between the first standard deviation and the VWAP, and it could do that multiple times. Could be a good place to do scalping if you're a scalp trader. You might have taken a short up here and then waited for the market to move down to the volume weighted average price down here. And then down here, take a long and wait for the price to move back up to the first standard deviation. You could do that many times, but again, you've got to be careful. Breakout could occur in any one of those oscillations. This is why this zone is a very difficult zone to trade in. Whenever you see price action near the PVP, a red light should go on. If you're a new trader, you don't want to be taking trades around here. This is not safe. Your trades should be below the volume weighted average price or the first standard deviation, and you can use something like the Shapiro effect to decide whether you should take trades there. But in this region, it's a totally different ball game. Okay, so price moved almost down to the VWAP. Let's see if it touches here. Yeah, touched. So if you were a scalper, you might go long here. The price is moving, still moving down. Okay, that's the danger of scalping. You may have to take a loss in here. The price doesn't move right on the next bar. And price is coming back up. Okay, so we got a reversal there. See whether or not price heads back up to the first standard deviation. And it's going back down. Not much you can say about this other than just watch it and wait. If you wanted to trade a short, for example, at the volume weighted average price, what would you do? You'd wait for price to move below and then retrace back to the volume weighted average price, and then use the Shapiro effect to decide whether or not the price is really going to move down to the first standard deviation below the VWAP. That didn't happen here. Price is staying above the volume weighted average price, or oscillating around it. So at this point you do nothing. You just sit and watch. You see what happens here. We'll see whether or not prices will move below the VWAP and then retrace and then move back down again. So far nothing's really happening. You just get oscillations. Again, a scalper may be in this trade long, looking for prices to move back up to the first standard deviation. Peak volume price is still sitting at 13,203. That has not changed. I like to call this region in here the DMZ, the dead man zone, because you really don't know what's going to happen. So you just follow the market and just watch and see which way it's going to go. Let the market decide what it's going to do. Okay, we're moving back up now to the first standard deviation. If we break through again, you should take a long trade. Still oscillating around the peak volume price here. Very disconcerting and a very difficult region to trade in. This is not a region I recommend someone who is not comfortable trading in any region to take a trade. Market gets very finicky here. Can't make up its mind what it wants to do. If it can't decide what to do, you certainly can't decide what it should do. You just don't know. So we're still bouncing around the peak volume price. Bouncing around the DMZ. Okay, we're still at 13,203 for the peak volume price. VWAP is down here at 13,180. First standard deviation at 13,211. So if we break through 13,211, we should take a long trade to the upside. When that price action moves it away, put your stop at break even. Okay, there we are, 13,212. Take the trade. You have a breakout to the upside. 13 to 19, 18, 16, 20, 21. Okay, hit the break even button. This market comes back, you'll be just stopped out, but if it doesn't come back, you're in the money. Depending on how many contracts you trade, of course, you can decide to take part of it off at 13,242, or if you're just one contract, just bail out. 13,241, say. Okay, 13,240. All right, one contract, you're out of the trade. So that's what breakouts look like. It's not a very pleasant experience initially when the breakout occurs. Not much else I can tell you about this. There's really not much else you can do. If you didn't get this breakout here, the next thing you can do is wait for prices to move above the second standard deviation in this breakout. But don't take the trade initially. Let a retrace occur, and then use the Shapiro effect to decide whether or not the trade's going to be valid. So that's how you play this region. To summarize, the market can move back into the region where the PVP is. When that happens, you really don't know which way the market's going to eventually decide to go. If it comes back down to the VWAP, then use your standard basic trading technique to decide whether you should take an entry. You wait for a retrace at the VWAP and then use the Shapiro effect to see whether or not the trade is in fact going to be a good trade. If the price moves up to the first standard deviation in this zone, then take the breakout and hope for the best. When the breakout occurs and the market moves up, put your stop immediately at break even and see what happens. If you're in just one contract, then take your exit at the first standard deviation. Excuse me, the second standard deviation up here. If you're in with more than one contract, take part of it off. Hang on if it's possible, and wait for the move up to the third standard deviation. Things like that will occur on strong breakouts. Okay. Hope this offers some explanation as to what you should do in the DMZ region. Have a good one.